Good afternoon. This is Brian Shannon speaking from Alpha Trends Blogspot. Today's Monday, the 22nd of January, 2007, and the market's closed. And we saw a little bit of selling in here today. The S&P 500 closed down 62 cents, as measured by the spiders on the screen right now. That's about a loss of about 0.4%. And looking at the daily time frame, there's been zero damage done here to this uptrend so far. But when we take a look at a shorter term time frame, like we will in a moment here, to take a look at the 10-minute time frame, you can see that we did take out the low from last week where we had thought there might be some support. So until the market can get back above there and above this declining 5-day moving average, I think it pays to be very cautious in here. So that hasn't changed. I've been saying, and I continue to believe, that we're in an environment where we need to be very cautious. It is earnings season. We've seen a lot of volatility as well, and volatility typically comes near turning peaks, turning points that is, and we have catalysts out there for big movement with these earnings reports. So when we have a higher risk environment like we do right now, it pays to take things slow, smaller share size, and make sure you're honoring those stops. But right now, the resistance in the S&P 500 looks like it's about 142.35 up to 142.70, where that 5-day moving average is, until it can get back above there. And in fact, back above this 143.10 level, getting above there might take the bears off guard, as I was saying this weekend. But so far, no reason to think that this market is in danger of a bigger breakdown, because we still have a bullish daily time frame. However, it's really more neutral than anything. Let me back up there. The daily time frame is more neutral than anything. When we take it to the shorter term time frame, we are seeing a little bit of weakness, so that just says be cautious in here. On Friday, the NASDAQ 100, we saw last week that this failed breakout a lot of times leads to a fast move lower. So failed moves often lead to fast moves, and I've been saying that I thought this market was more fragile than the S&P 500. And today the loss in the NASDAQ 100 was 48 cents, or a little bit more than 1%, almost 1.1%. And that makes it obviously about twice as bad as the sell-off we saw in the S&P 500. So it was correct to observe that this market is more fragile. It's we've been looking at this trading range really that it's been in 43 to 45. We had that false breakout, so it looks like we're probably going to get a test of the $43 level. That's kind of what I was looking for last week. We'd also noted the Fibonacci retracement, and that there might be support at that 61.8% retracement level. 50% tried to hold on Friday, and then they tried to hold them here near the 61.8% retracement today, which, is at about 43.5 or so. We did obviously trade a little bit lower than that intraday, but we saw a little bit of buying towards the end of the day. Not very impressive at all. Just more of a kind of a grind higher, and the volume was not very convincing. The volume was diminishing on this rally, which leads me to believe that there's not a strong chance that we're going to see a turnaround here. And certainly all these moving averages suggest that the trend is lower, so it's time to be really sidelines, or hopefully you took advantage of that sell-off there. For now, I would say 44 is going to be the major article and the obstacle in the near term here for as far as potential resistance in the NASDAQ 100. And breaking below 43.50 convincingly might bring us down to that 43 level quickly, and maybe even a little bit lower than that. But the main message here is that we want to be very careful with these stocks, and it's not time to be aggressive, long or short. The semiconductors have been the real laggards here over the last, really the last couple of months, because they haven't participated in the upside. But the last week and a half, they sold off a lot harder than the broader indices. These semiconductors lost 0.7% today. They were down 23 cents. But they're getting down towards the bottom of this range. I think it makes it higher risk for selling short down here, but I certainly wouldn't want to buy these things long. Like I was saying on Friday, I'd really like to see this market rally up towards 34, 34 and a quarter. I'd like to see a rally like that take place on light volume, and then be able to sell these things short for a break below the support as it started moving back lower again. But for now, realistically, looking at this 10-minute time frame, we did make a lower low today, but then pop back up above that low from Friday. So I think you're best off just sidelines for the semiconductors. And finally, we'll take a look at the mid caps, the MDY. And this group seems to hold up realistically probably the best in here. It's in the middle of the range. It found a little bit of support near that 20 and 50-day moving average. They were down today, but only 0.2%, 0.22% with their 32-cent loss. And until it really can get above 150, though, there's not any real reason to be majorly bullish. I would think, though, that maybe taking out the 148.70 level or so would lead us to that test of 150. So if it can get above that 148.75 level, I think we're in for a test of 150, and it's possible that that 150 level might not be able to hold these mid caps back. So overall, we're just in a very neutral range in all the markets you look at. You can make a bullish scenario, I think, for the mid caps and the S&P 500 based on their consolidations on the daily time frame. But then when you look at the NASDAQ 100 Trust, the Qs, then you're looking at something that possibly could lead to a bigger failure after this failed breakout. So all in all, it's not time to get aggressively short. I get emails that are saying, "Hey, can't you see this is the top of the market?" And my message is, no, I cannot see that. I can only see the top after it's already occurred, and I'm not confident I've seen it yet. I'm never going to be the first one to call bear market, but when we have evidence that we're actually in the bear market, that's the trend I'm going to go with. While it's neutral sideways and I'm unsure, then I'm going to say take it slow, be cautious. That seems to me the prudent way to look at the market rather than always trying to be right and being bullish or bearish. The Align Technology, we were looking to buy that above $14.47. That trade did not set up for us, so there was no trade taking place in there. We were looking for a pullback to 590 in Cozy and then to buy it above 607. That trade didn't set up either. We did have a trade trigger in shares of Focus Media, though. What we were looking for here was a pullback to 75.20. We got that, and if we look at the 1 minute time frame, you'll see that that 75.20 level was hit right here early on, and then we bought it at 75.35, and we're pretty quickly stopped out with a 65-cent loss in shares of FMCN. eBay, we had taken a look at that as far as a potential short sale. We wanted to see it rally up towards that 5-day moving average at 29.85, and then to sell short weakness at 29.65. So that's working once again, and I think you can put your stop at about 29.50 in shares of eBay. And finally, we looked again at the U.S. oil fund, USO. What we were looking for here was a pullback first. We were looking for a pullback to 43.80. So 43.80, we did get our pullback late in the day here to 43.80. And then what we were going to do was look for, let's take a look at it on this 2 minute time frame. 43.80 is right here. And then we were going to purchase it as it got up to 44.20. Now this here would lead you to believe that it did trade above there at that time, in which case we would have gotten stopped out. I think there was a bad print in there. Let me know if it wasn't a bad print and you did get stopped out. But otherwise, what we were looking for was a pullback to 43.80 and then to buy it above $44.10. So you can see that since that occurred, the stock did not trade above $44.10, so there should have been no trade taking place. I might be incorrect that that wasn't a bad print, but I didn't see it occur on my screen, so let me know if the case is otherwise.